Good morning, everybody. This is Patrick MontesDeOca with the VCPMI early morning update for December 22nd, 2020. I want to wish everybody a happy, joyful, and peaceful holiday. And I hope all your wishes do come true. Let's move right into the live streaming room here in Ticket Talker. And take a look at the gold market, trading last at 1881.40. The gold market has not reacted to the stimulus confirmation that the federal government is going to supply about $900 billion in stimulus money. And one of the things that I want to focus on is the fact that, first of all, what the market seems to be demanding in terms of the gold market or the economy, what seems to be demanding that a lot more stimulus is needed. This is just a Band-Aid that's going to help the economy for the next maybe few months. I think $15 billion was allocated to the airlines industry to keep the furloughs, so to speak, employed for another few months. One of the things that I've been focused on is the fact that the market back in March, when it made the high of 2089, discounted a lot worse or more damage than we are beginning to see. And it anticipated at this point that the Federal Reserve was prepared to leverage about 10% of the GDP as stimulus if this crisis requires that. So they have pretty much used less than 50% of that so far to date, including this latest bout of stimulus of $900 billion. The gold market discounted at 2089 the value of the damage or the risk the damage would bring into the economy. But it did not anticipate a second lockdown. And this is very important to take into consideration in terms of where the price of gold is headed. So when you take a look at the market from a technical point of view, from the high that we made at 2089 to the low that was established in March at about 1451 roughly, you're getting, if we use classic Fibonacci retracements, a correction or anticipation of a 50% correction at about 1771. And this was before the market pretty much went into a bearish consolidation since the high was made at 2089. Now, the low was made at 767 on November the 30th, coinciding with the 50% Fibonacci retracement of 1771. And the market reverting back from this low and identifying the buyers in the market activated the upper end of the extreme levels above the knee. And those targets obviously were the monthly major targets, monthly average price of 1848, roughly, and you begin to fall into the patterns that we are currently, or the structure that we're currently trading from. But if you use just classic Fibonacci trend lines, Fibonacci retracements, which we use pretty much to combine the or integrate, you might say, the code or with the code, we begin to identify a harmonic relationship and validation and confirmation. The market ran up to the high of 1870, above the monthly average, and we've been consolidating in that level, and obviously taken us all the way up to this to test the second Fibonacci trendline resistance that coincides with the 1910 shorter term resistance levels that we have here for today, and that we had here yesterday at about 1913 for the daily. The weekly target of 1919 is still active, but what we have seen here now is that the market got up on this leg, met this resistance, and found supplies appear. Now, you would think that because now we're getting more supplies into the market will react bullishly, and the gold market would be exploding in a sense. But as a trader, what I want to point out to you is that we've been talking stimulus now for, I can't even remember how long. We have politicized the issue so much that in the process of discussing this item at this figure, the economy has gotten a lot worse. We are in the second lockdown, Europe, United Kingdom, and it's a deeper lockdown. And one of the things that pretty much I have learned in trading in the gold market, that this algorithm identifies, is basically the extreme level of sentiment that brings the price to a level that, mathematically speaking, the probabilities increase, you might say, to counter trend the sentiment. If you're a trader and if you're in this to make money, then you are trading against the sentiment of the market. And what you want to do is initially, obviously, you want to, first of all, identify and see where those extreme levels of supply and demand are so that you can hear the sentiment against what the price or the market is telling you. And that pretty much what happened yesterday here is the market getting up to 1912. It discounted this stimulus that was approved. And what the market is saying is that it needs more stimulus. It wasn't enough for the gold market now to challenge that 1950 area or higher levels of supply, you might say, that you see here being identified. And so the price is saying, basically interpreting that it got overpriced, it got overbought in anticipation of the stimulus, and now that the stimulus is a fact, it's pretty much buy the rumor and sell the fact syndrome. If you're a trader, and we're talking about trading the market, not trying to resolve the economy or the pretty much policies that are being implemented or not. It's how the fundamentals, which is what we're talking about, react to or relate to the price, and how you or I, as a self-directed trader, as a trader, want to monetize on that anomaly. And that, obviously, everybody that, if you watch the news or the internet, the last few weeks has pretty much the internet and the news media has been flooded with news about the gold market exploding based on stimulus. And in fact, what is exploding instead is Bitcoin. So that's another, I think, discussion that's building to be a very important discussion in terms of what the cryptocurrency is going to look like here as we move into next year. Coming back to sound money, real money, which is the gold market here, if we can take into the fundamental picture that is being presented to us, the market is saying that it's not enough money on top of a vaccine, positive vaccine news that are coming out. The market probably is going to revert back down to test the extreme levels now below the mean. Now, if we take a look and focus on the price action outside of the fundamentals that I just spoke with you, and I have, I think, the perfect condition of the market, to tell you or show you or share with you what these fundamentals are, which I don't have to get much into it. All you got to do is, read the media or listen to the media. But I, as a trader, what this is saying to me is that the market is looking to, first of all, it reverted and activated a short trigger as of yesterday. The market now trading under the daily average price of 1884 and the weekly average of 1870 is in a neutral zone. It's the average, and this is what the AI pretty much recommends when the price is at the average, is that you do nothing. In terms of day trading, it's neutral. And you can begin to see, even if we take a look at the monthly of 1848, that the market did enter into a bullish trend momentum, but found supplies right into this resistance level or supply level identified by the VCPMI, not quite getting up to, again, 1919. And that's what we want to see, is that the market validates the anticipated intelligence. And once it validates this intelligence, then it begins to confirm the price momentum of the market. And it begins to reflect in the price. So ideally, what I want to do is identify the highest probability trades. And this identifies, this code identifies for me where the levels are that I might be interested in taking a look at the long side of the market. And that is basically at 1857. As you can see, it's the buy one today. And right below it, you're looking at the monthly 1848. And so I think the first target that I would like to see, tested would be the 57 to 48 levels. Right underneath those levels, you have tremendous support because you have the buy two daily and 1831, and you have the buy one weekly of 1837, which almost begins to align the prices harmonically. $31, $37, $48 are pretty close in its vicinity. And so this is where ideally I would be interested in buying, and I would recommend all my traders, my subscribers, this would be the level that you want to identify the long side of the market once again. In the meantime, we are protected, as I've been recommending, hedging up into that specifically 1910, 1913 level. Where 30, 40 cents off those highs already. So I'm going to continue to hold on to this sentiment, which is a counter trend swing correction back into the extreme below the mean. Let's take a look at silver. Pretty much following the same pattern, except the volatility is far greater in the silver market. And the silver has been leading this rally that we've seen here recently. And it looks like it's also leading, on the way down. Coming down below the Fibonacci trend line resistance is confirmation. It met all the targets above. The difference is that the silver went into the weekly signals and activated, and it's activating now a bearish trend momentum. The gold market got up to the second Fibonacci trend line resistance and reverted back down, as opposed to the silver market. So I think the silver got a little bit ahead of itself in here, it looks like. And I think we're justified now to trade against the sentiment out there that is pretty bullish. It's pretty bullish for stocks, and it's pretty bullish for gold and metals. And I think that the surprise or the path of least resistance, I think, is going to be to the downside. The market needed to see not only this bout of stimulus of roughly $900 billion, but it needs to see now, as we come into this new year, that this new administration is serious about stimulus far greater than anticipated. And I think truly, particularly because of this second lockdown, and we have yet to see the damage that's causing right now. You can just do the math, and you got to recalibrate and readjust the previous, pretty much forecasts to include a lot of this new damage being done by the second lockdown. Let's watch the market. It's a very quiet day today here, low volume. So let's just watch the market here, and I will continue to update you throughout the session here. Continues to be a very quiet day. Not much action here. Pretty much across the board, except that we have a very active market here in Bitcoin. We trade the Bitcoin Investment Trust in terms of following the Bitcoin. And you can see here that we've seen a phenomenal move here in just the last few weeks here, from a low of 22 to 32 approximately here that we're looking at. And it just looks like this market is exploding here. And it's a pretty much, I believe, level that deserves a bit of caution. Once again, the sentiment is extremely bullish, just as bullish as the gold market. And I think what I believe potentially is leading to is that you want to protect, first of all, any equity that you're building if you're long the market, but there are a lot of holes underneath that are gaps that need to be completed before the market continues to run up, because the higher that the market runs up from here without filling this foundation of gaps, the harder that it stands to fall or revert. So, it's a high risk game right now. It's certainly a tradable asset with phenomenal volatility. And that's all it is. It's a tradable asset. It's a virtual tradable asset. So, trader beware, so to speak. Coming back again to trading the gold market, which is more traditionally, for thousands of years, has been used as currency in times of chaos economically or politically. So, but it does give you the opportunity to trade it short term. If we get this kind of a correction in the market, this consolidation here, coming back down in here, I think is the market is creating. Even if we do see a little bit of a correction here, which is what I would love to see, because I would use this correction to add to my long-term positions. Coming back down into this 1860, 1870 level is a phenomenal buy-in opportunity. And this is where I would recommend, if you are looking to buy the market, depending upon your profile, depending upon how much you buy in, and depending upon how you manage your risk, you can scale into this position and buy into this correction. I think one of the general interpretations or comments, obviously, that are being made as a consequence of this tremendous stimulus coming into the market, how it's going to affect the US dollar as the US dollar world's reserve currency in terms of its purchasing power, in terms of its intrinsic power. And The path, you might say, that the government has to take, unfortunately, very few choices, is to, first of all, debase its currency by providing supply to the market in order to maintain the equilibrium, and so that we won't go into a panic as we did back in 2008, where we had a shortage of dollars and we had a credit crunch in the financial markets. And so the government has to make sure that they have the printing presses open to print as much money as needed and be prepared to print even greater amounts than that with a margin of error. And that debases the currency, and a lower currency supports commodity prices. It supports the idea that a weaker currency is good for exports. And we have seen the market in grains obviously reflect this by trading at 1252. It's just exploding in terms of the price of soybeans. $12.43 a bushel. And this cost of food that we're looking at in the wholesale end of it, in terms of the soybean, which is the major grain product, that out of that product, obviously, you can crush the bean and produce soybean meal, soybean oil, that are both applied for human and industrial consumption. So it's a leading indicator in terms of the cost of food on the wholesale end of it. And if the price literally has doubled in soybeans, what do you think is going to happen to the retail level? Somebody's got to pay for that. So, in fact, this weaker dollar has it's inflationary is another word that will be reflected in the price of food. So prepare for a shortage of food. Prepare for food prices to explode. Prepare for inflation to move into the commodity area. It's inevitable. It's inevitable. Just going back to the basic law of supply and demand. The stimulus or the pandemic, which has caused a tremendous damage to the world economies, not only here in the United States, but to the world economies, demands that central banks and governments open up the printing presses and prepare for unprecedented increases in the money supply. When you take a look at the US Federal Reserve, the money supply has increased 25%, which is staggering, since 2008. And so there's a lot of money in the system, which is the reason why the system is not collapsing. And it's being obviously supported not only by the tremendous amount of pretty much support that's coming in from the virtual economy, on top of record amounts of supply of US dollars in the system. And this is what's holding right now, pretty much, I believe, the monetary system from imploding on a global basis. And in doing so, collapsing world assets, basically, across the globe. Sovereign wealths of major economies are at risk. And so the central banks and the government officials running this show cannot afford for the world economy to implode. And they are determined to print as much money as needed. So, we pretty much are talking about, at some point here, all of this money that's in the system is going to create what they hope to is some kind of inflation, but inflation can only happen, obviously, by the velocity of money exceeding the supplies available. And, with a lockdown here, it's very difficult to have any kind of velocity, you might say, of money in the system, because people are not going out and spending as normally they would during a normal situation. Most of the economy is being filtered through virtually. And so I believe there are a tremendous amount of anomalies that need to be adjusted as we begin to move into a more normalized economy. And the expectations pretty much is that all of this pent-up demand as a consequence of the lockdown are going to create and chase pretty much fewer goods that are going to be available over the next few months, like food. So what I'm trying to do here is, how do I monetize? How do I make money? I'm not an economist. I'm not a PhD. I don't need to prove myself to be such. But what I'm looking for is, how do I take this plate that I've been given and monetize as a trader, as an independent trader? And pretty much, that's what I do here. I've been doing now approximately over 250 or 60 hours, live trading hours, in which I have made $1 million in real time, showing you how you can do it using the VCPMI. It's a question of what is your profile. It's a question of risk and money management according to your profile. And it's a question of allowing pretty much your emotions to become your best indicator as opposed to your worst enemy. The VCPMI is a contrarian algorithm that will tell you when everybody out there is buying, more than likely the VCPMI will be telling you sell, as it did yesterday. And what I'm looking for now is the highest probability is that when the market tells me to buy, and that's pretty much when everybody gives up. And you begin to see the chatter out there begins to build, and it's usually at an extreme. So this is what mean reversion trading basically means. You trade the reversions to the mean in terms of price. Not much here to do today. I am just holding on to my position here as we move into the holidays. I think it's going to get pretty quiet. I think for us, Christmas came in a little early for us. Christmas came in around the 20th, you might say, where we took advantage of this rally and we locked in a solid $1 million in profits here for our live account that we're trading, which you can see at ima2tradelivesignals.com. But that's with the digit number 2 at your leisure. And the signals used are the very same signals here that I share with you as a courtesy during this hour live streaming here in TikTok. This has been a very, very challenging year for most of us. And I think for a lot of people, it still remains to be the case. But I do want to point out that any time, if you can refer back to history, any time that we've been through a major crisis, it has become pretty much an incredible opportunity. Even after the 1929 crash, pretty much, it created an incredible renaissance, so to speak. Even then, it's the renaissance after the crisis that we got to be looking forward to. The monetary system is going to be reset according to the World Economic Council here come January. There is a meeting of the major world leaders, the economic world leaders in Davos in January. And I think a lot of these topics of monetary policy, virtual currencies, I'm sure are going to be unfolded. The one thing that I don't see in terms of trying to read between the lines, is a policy that is against this Keynesian economic philosophy of thinking that providing unlimited amounts of stimulus to the economic system would create economic recovery, economic growth. I think, I believe it's the opposite that occurs. And that's a whole different argument, philosophically and politically, as well as economically, that you need to get into. The next few days are going to be obviously very slow. The holiday time, a lot of volatility can happen during that time because most people are on vacation, holiday. They're not trading. And sometimes you get some paper that comes in and creates the volatility, you might say. So you never know, and particularly during this time of political uncertainty and economic uncertainty, it's hard to say pretty much what could happen. The only thing that I can say to you is that if in fact we do follow through with this pattern that's unfolding in the metals and we get a chance to test that 1840 area, you want to take a look at seriously at the level all the way down to about 1810 as we take a look at the longer term signals. 1840 is the monthly average, and right below it you're looking at the 360-day cycle average price of 1810. What you're looking at here is 1913 was the monthly level that we've been trading from all the way this month. And getting up to 1912 pretty much sufficed and completed the criteria for the previous pattern to be completed. And once upon the market failed to get up there, and even the Bollinger Band identified the level of resistance up there, the market has reverted from that level, again activating the monthly target of 1840, which is where we are right now. And so what we want to see is, first of all, what the price does as it comes down to 1840. And potentially 1810 right underneath. So my major interest in buying this market is 1840 to 1810 for the remainder of the month of December. As the market begins to validate and confirm that the resistance that we saw yesterday, the high that we saw yesterday, probably is going to be the target for the short term completed. Now we're going to be looking at a reversion unfolding where you get a lot of momentum on the downside because a lot of these buyers that came in anticipation of the stimulus are getting nervous. And they start to sell their long positions, liquidate, and that precipitates pretty much the downward momentum that I think is going to bring the market down and to test this 1840 to 1810 level once again. $1869.30. $69.20 traded. So we're getting a little more selling pressure in here as we've been anticipating, and I'm comfortable holding where we are. Continue to look for this correction, possibly again to test that 1840, 1810 area where I would be a buyer upon confirmation and would look to cover my short strategies that we've implemented a few days ago. It looks like the derivative dust is taken off, and that is pretty much a bearish instrument that we use to as one of the hedges that we use. And so you can see the market has just completed a bottom at 1851, and we are just taking off on the upside, which has given us the downside protection that we want as the price comes down here now and begins to activate a weekly bearish price momentum, trend momentum, and the 1857 1848. This signal right now coming down below the weekly average has activated 1837 as your target. Once again, everybody, thank you so much for the privilege of sharing this information with you. And I do sincerely hope that every day you come here, you become a better trader. Have a wonderful holiday. I'll talk to you next time.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
The Ticker Talker app brings the powerful trading technology tools of the Ticker Talker desktop platform into the hands of its users who are on the go. Ticker Talker connects novice and advanced traders with industry leaders who are providing real-time trading content throughout market hours every single day. The Ticker Talker app allows traders to follow and get real-time push notifications of trading